So the dollar, Trump last time around, same thing. The markets priced in tariffs. The dollar screamed higher. It created this weak patch of growth. Trump came out and said the dollar's too high. Guess what? Scott Bessent, who's a macro hedge fund manager, I've known him for 20 years, 25 years. He understands the game. Trump said the same thing. Everyone said the same thing. The dollar's too strong. And hey presto, the dollar has utterly collapsed. So it's a very powerful setup. A weak dollar is incredibly good for world growth. It allows China, everybody else to start exporting. The whole world economy starts picking up. The last time this happened, the Trump cycle, well, that was the initial correction that we got. We had this whole period of correction, much like we've had now. It stopped in about March. Well, we got to about April. And then we did this. And from that correction low, it did a 23x.
Over the past month, Bitcoin and the broader crypto market have been gripped by intense volatility, a roller coaster driven by shifting economic signals and powerful institutional forces. As investors recalibrate their expectations around potential U.S. Federal Reserve rate cuts, crypto prices have whipsawed between sharp rallies and sudden corrections. Spot Bitcoin ETFs remain a critical driver of this momentum. Steady inflows have powered price surges, while outflows have triggered swift pullbacks. Adding further fuel to the volatility are fresh regulatory moves out of the US and Europe, combined with growing geopolitical tensions. Together, these forces are shaping Bitcoin's evolving identity, straddling the line between a high-risk speculative asset and an emerging safe haven in uncertain times. With Bitcoin and major altcoins stuck in a tight trading range for weeks, a crucial question is emerging. Has the crypto bull market already peaked? Or is this just the calm before the next surge? Many investors fear we're slipping into another prolonged crypto winter, but not everyone agrees. Real Vision founder and CEO Raoul Pal, a seasoned macro strategist and former Goldman Sachs executive, believes the real breakout is still ahead. In a recent keynote at the SUI 2025 base camp, Pal laid out compelling evidence drawing on historical patterns and deep correlations between Federal Reserve liquidity, interest rate cycles, and crypto asset performance. All of which he argues point toward a powerful upside for Bitcoin and the broader crypto market in 2025 and beyond. As we dive into key clips from his presentation, take a moment to support the channel. Hit the like button, subscribe, and turn on post notifications so you never miss an update. Your engagement makes a huge difference and helps us continue bringing you high-quality crypto and market analysis. Thanks for your support. Now, let's get into it.
Firstly, I use a framework that I call the Everything Code. It's something that I've spent 35 years building in macro, where I started to realize that the dominant factor in all of macro is actually liquidity and the debasement of currencies, and it explains most price movements in all of the assets that we care about. And I realized it was all to do with debt, and it came from why we're seeing 4-year cycles in crypto and the economy and all of these things is actually driven by the debt refi cycle. The world just reached too much debt back in 2008, and what we've been doing since then is servicing the debt. We've also got some other key factors. This chart is a chart that I produced a few years ago. It's still the single most important chart in macro and explains everything that is going on in our world today. And this is the fact that demographics is everything, and the demographics of the aging populations across the Western world, these are the US numbers using the labor force participation rate, explain the build-up in debt. Why that is as populations get older, economies slow down. To service the existing debt, it requires more debt. To create GDP growth, you need more debt. See, GDP growth is driven by population growth, productivity growth, and debt growth. And debt growth has been the driver both in the US, in China, in Europe, in the UK, all across the world. It's all driven by the same dynamic, and that's this aging population thing. It slows down GDP growth and creates unstable economies. And that chart just shows the stunning correlation between debt to GDP, and population itself. What's interesting is then when you go one stage further and say, okay, we're seeing this debt, how are we dealing with this debt? And it's actually just driven by liquidity. So here I'm using Fed net liquidity. Fed net liquidity is the balance sheet of the Federal Reserve, the Treasury General Account, which is the Treasury themselves, not the Fed, and then the reverse repo facility. These are the levers that they've been using. It started just using the balance sheet, 2009, all the way through to about 2014, it was just the use of the balance sheet. Then they started sneaking in new ways of debasing currency, and that was by adding in these other levers, getting banks to put reserves here or take reserves out there, or injecting money into the economy via the checking account, the Treasury General Account. That's actually shifted to total liquidity now because everyone figures out the game, which is the debasement of currency, debase the currency, try and grow GDP growth at lower debt to GDP or just manage it. Now they're using total liquidity, which includes measures like M2, which is the banking system as well. So when you add those things up, this has, and I'll show you these charts later, the most stunning correlation of all time to all assets. So 90% of Bitcoin's price movements are driven by total liquidity, and 97% of the NASDAQ. So here's the real issue here. Why are the rich getting richer, the poor getting poorer? Well, scarce assets keep going up in price. Real estate, equities, art, gold, all of these things. Young people can't afford it. Poor people can't afford it because they've got variable income, which is earnings, and it buys them less of these every year. What's actually happening, what that mechanism is a tax on everybody of 8% a year. A global taxation of 8% a year that you don't understand. You just don't get richer by 8% a year. Add in another 3% global inflation, you're at 11% debasement of currency. That's your hurdle rate to stay as wealthy as you are today. That's a staggeringly difficult thing, considering most asset classes don't produce those kinds of returns, which is why so many young people have come to crypto, because crypto completely upends this system. They can't buy houses, they can't buy all of the other things that older people were able to afford. So they forced into more speculative, high risk assets that have much higher returns. It's the only way out of the trap. And the trap is driven by this debasement. So if you want to see how close the correlation is, and I'll show the full correlation chart later, it basically drives Bitcoin. And what we see is there's periods where it decouples, and these are the banana zones. It decouples when what we get is the retail frenzy and the frenzy into the market, cools off, comes back to trend rate of this debasement of 8% or so. But over time, it produces astonishing returns. And that's why Bitcoin looks like this on the log regression channel. It's also still remarkably cheap. Where it ends up at the end of the banana zone is usually the 1 or 2 standard deviation level. We're a long way from that, and that will give us much higher prices. You can't see it on this. But if it were to get to 2 standard deviations, that would put Bitcoin at $850,000. I don't think it's going to go there, but what we're saying is there's plenty of upside to come. I know people get frustrated in sideways markets. It's just the nature of the beast. It does nothing, corrects for a while, and then explodes out of the traps. And we're kind of in that phase now that I'll talk to you about.
What Raoul Pal just laid out is a powerful blueprint for understanding not just Bitcoin, but the entire financial system we're living in today. At the heart of it all is liquidity, the fuel that drives markets higher and drives them up during downturns. And according to Pal, this liquidity cycle isn't random. It's deeply tied to global debt, aging populations, and a financial system that's been forced to debase currency year after year just to stay afloat. And here's the kicker. In this game of constant debasement, scarce assets like Bitcoin have become the only real way for younger generations to fight back. They're locked out of housing, priced out of traditional assets, and left searching for something that can outpace that hidden tax. Pal talked about the 8 to 11% annual hit on your purchasing power that most people don't even realize is happening. This is why Pal believes we're not at the end of the crypto cycle, but rather in the middle of a setup that could unleash the next big wave. He points out that Bitcoin moves in phases, long periods of sideways consolidation, followed by explosive rallies that break away from the norm. Right now, according to his framework, we're still well below the kind of price extremes we see at the peak of these so-called banana zones, those moments of retail frenzy when prices go parabolic. In other words, if history is any guide, the real breakout is still ahead. So, while the market might feel slow and frustrating today, the underlying forces, liquidity injections, demographic shifts, and debt-driven debasement are still quietly building pressure beneath the surface. And when that pressure releases, Pal argues, Bitcoin could surge far beyond current expectations. Not necessarily to the extreme highs like $850,000 that show up on some models, but certainly high enough to make today's sideways action look like the calm before the storm. If you've made it this far, I'd love to hear your take. What's your perspective on where the market is headed next? Drop your thoughts in the comments below. Let's get a conversation going. And if you found this breakdown valuable, don't forget to hit that like button. It really helps support the channel. For more deep dives into macro trends and crypto insights, make sure you're subscribed and have notifications turned on so you never miss an update. Thanks for watching, and I'll see you in the next one.